about the balance sheet. The balance sheet provides financial information in three large categories: assets, liabilities, and equity. It is called a balance sheet because the total sum of assets must be equal to the sum of liabilities plus equity. The assets provide a snapshot at what the company owns, whilst the liabilities and equity provides an idea of how the assets are funded. It is customary to represent the balance sheet in two columns: assets to the left, liabilities on the upper right column, and equity on the lower right column. From an accounting perspective, assets can be converted into cash. From a strategic perspective, however, assets need to generate income. The subtle difference between converting to cash and creating income has a large impact on the way a manager makes strategic decisions. It is the equivalent of saying that a person eats either to exist or to grow. Assets don't generate income unless we act to use them. They are tools. We must do something with assets. We must activate them. An asset waiting to be converted into cash can lose value. Imagine owning a house and expecting that just by owning it, it will generate income. Even if you plan to use a property manager, you must identify, agree on, and manage that property manager. You must also pay taxes and carry out at least some minimal maintenance. Now think about that house's value if it is unused. You get the idea. Let's turn now to liabilities. That is what a company owns. There are two types of liabilities: short and long-term. Short-term liabilities are debts that must be paid within 12 months. For example, suppliers' invoices, taxes, utility bills, and salaries. Long-term debts have to be paid in a period longer than 12 months. For example, loans and special credit conditions from suppliers. The last part of the balance sheet is equity, which refers to the value of the ownership of the firm. At the launch of a firm, the founders allocate a specific amount of money and transfer it to the firm for its day-to-day operations and investments. Equity can increase or decrease as a result of operations and is calculated in retained earnings that we spoke about before. Owners can also raise capital. Initially, most companies lose value, trying to understand how to function in the marketplace. Therefore, the value of equity decreases. Gradually, managers improve the firm's processes, select the offers that are more appealing to the market, and form a team that adapts to circumstances. The company becomes profitable or more profitable, and part of these profits is added to the equity as retained earnings, increasing the value of the firm. Another part can be distributed as dividends.